U.S. futures rallying across the board this morning as traders digest the Fed's half-point rate cut. Or half percentage rate cut, we should say here. Stocks wavered for most of yesterday's session after the decision and ultimately ending the day lower here. Joining us now with a closer look, we've got markets and data editor Jared Blikre and senior markets reporter Ines Ferré. Jared, let's start with you. I mean, yes. My goodness, thank goodness it wasn't half a point, but but at the end of the day, I mean, what is most striking about this decision to you, and what could this signal going forward about the market?
All right, 50 basis points was kind of a big deal for me. I think 25 basis points sends one message and 50 sends another. The message I'm seeing with 50 basis points is we are a little bit concerned the data is weakening more quickly than we expected. And I think that's evident in the market's reaction yesterday, which was a bit tepid given the fact that this was a big momentous event that everybody's anticipating for years. There might have been some bullishness in the lead up to it. But let's go to the Wi-Fi Interactive. I have a couple of charts to share. And I think all of what happens with the market right now depends on whether or not we slip into recession. And it's probably too late for the Fed to backtrack and say, all right, we should have done this when. The wheels in motion are going forward. That's why we talk about these long and variable lags. So what we're seeing here is how stocks are reacting to rate cuts differently over time. And these are all averages. So this goes from 12 months before to 2 years after. And this cyan line right here is what happens to stocks when you have a recession. You can see that they go down and they go sideways for a long period of time after. When you have just a growth scare, that could be a minor credit shock. It could be the Japanese yen, for instance. Or if you see normalization, that's a soft landing, stocks tend to go up over time. So I see 50 basis points as a potential problem here. And I think the fact that we did see the first dissent from a Fed governor in a long time, 2005, I think that means something too.
It does mean something too, and we're seeing that get even more attention, I think, this morning, and as investors have had time to digest exactly maybe ultimately what this would signal here down the line. And as I know you're closely watching the reaction that we're seeing play out in commodity space, specifically gold. What are we seeing there? Maybe what that indicates.
Yeah, and it's interesting because Jared was mentioning whether we are going into a recession or not. And what we had seen in commodities, barring gold, barring silver, what we had seen in commodities is a downward trend signaling commodity deflation. And this chart really illustrates this. This is from Bloomberg Intelligence. This chart shows that these commodities, which are 23 commodities, including aluminum, copper, Brent, it's rare that you see commodities be in such a sharp downturn trajectory.
It's a big concern.
It is at the start of an easing cycle or ahead of it even. So that's signaling that the Fed may be behind the curve here. When you do look at gold, we are seeing that gold has surged here. This is a different story when it comes to commodities with gold. Gold, when you date back to 1989, gold typically has risen as the Fed starts lowering rates. Goldman Sachs has this chart out from a recent note. They're showing that ETFs backed by physical gold holdings rise gradually when the Fed policy rate starts coming down. So since gold is, these gold-backed ETFs are backed by physical gold, then they would be reducing the physical supply of gold, sending up the price of gold higher. So they're expecting gold to be going up to 2,700 in early 2027. And what could send it another leg higher are recessionary concerns.
Yeah, Jared, you said it's a big risk. I mean, typically we see in a cutting cycle some of the riskier parts of the market catching a bid from investors, but you say it's
commodities in deflation mode is a bad situation right now. You want the economies of the world to be thinking about the future, where we're renormalizing, where we don't have a recession, and so depressed commodity prices is exactly the opposite I would expect to see if in fact we're going to have a soft landing. Now, anything can happen here, and we're also in a seasonally very bearish part of the year. The last 2 weeks of September, very bearish. We get through this, we could be fine for the rest of the year, but I think the next couple of weeks are going to be fraught with a little bit of difficulty.
It'll be critical for investors to be paying close attention to. All right, Jared and Ines, great stuff. Thanks so much.